Please like, share, and subscribe. Wishing you happiness and good luck every day.
Let's dive right in. There's a quiet crisis happening all across India. We're talking about millions of smart, hardworking people who are watching their life savings just stagnate, or in some cases, even vanish. And here's the kicker. It's not bad luck, it's not a bad economy, it's bad advice. Advice built on a foundation of myths that we've been told for generations. Financial writer Monica Halen just hits the nail on the head here. People are trying to do the right thing with their money, and then some persuasive person comes along with a deal that sounds amazing. And just like that, the money's gone. This is really the heart of the problem we're going to unpack today. I want you to meet two people. First, there's Devika. She's a super successful CEO who did everything the safe way. She put her money in real estate and gold, and after 20 years, her wealth had barely grown at all. Then you have Rajveer. He's a finance whiz who took the smart, aggressive route and ended up losing almost everything. What does this tell us? It doesn't matter if you're cautious or a risk taker. If your game plan is built on myths, you're probably headed for the same outcome: financial heartbreak.
So that really begs the question, right? Why does this keep happening? These aren't just one-off stories. They're actually symptoms of a way bigger problem, baked into the way we think about investing in India.
You see, this isn't just about a few people making bad calls. It's much bigger than that. We're looking at what you can only really call a nationwide investment crisis. The stories of Devika and Rajveer, they're playing out in millions of homes right now. So a report from the Reserve Bank of India dropped this absolute bombshell of a number: 95%. What's that? Well, that's the percentage of wealth that the average Indian household holds in physical assets. We're talking about stuff that just doesn't, and frankly can't, generate real returns that actually beat inflation. And this chart just lays it all out. I mean, look at this. A massive 84% of family wealth is just locked up in real estate. Another 11% is in gold. And that leaves this tiny 5% sliver for financial assets. The one place where your money can actually grow and compound over time. This isn't just a lopsided portfolio, it's practically a recipe for going nowhere financially. Okay, so let's start tearing down the myths that lead to this crazy allocation. And we have to start with one of our most deeply held cultural beliefs. We've all heard it, right? From our parents, our grandparents. Gold is the ultimate safety net. It's a reliable store of value that's always going to be there for us. And yeah, it's a really comforting thought. But is it actually true? Let's see what the numbers say. Now, this chart might look a little complicated, but the story it tells is super simple. Just look at the rows for annualized returns. It doesn't matter if you look at the last 10, 20, or even 30 years. In every single long-term scenario, the BSE Sensex, which is basically the stock market, has given way higher returns than gold. The data is crystal clear. While gold feels safe, it's been a pretty lousy engine for actually growing your wealth. All right, let's move on and tackle the biggest piece of that pie, the place where a whopping 84% of Indian household wealth is just sitting. And now for the big one, the belief that owning property is a guaranteed ticket to riches. For generations, buying a flat or a plot of land has been seen as the smartest investment you could possibly make. But what if that's just not the reality anymore? This chart, well, it paints a pretty startling picture. It compares house prices to what people are actually earning. And when you look at it that way, Indian real estate is just wildly overpriced compared to almost every other big economy in Asia. So what does that mean? It means there's very little fuel left in the tank for the kind of massive growth everyone expects. The great Indian property boom might already be over.
And honestly, the basic math just doesn't work out. The money you can make from renting out your property, your rental yield, is a tiny 2 to 3%. But the cost to borrow the money to buy that property in the first place, that's around 7%. You're literally losing money every single year just by owning it. It's not a productive investment anymore.
So, if physical assets are a problem, what about those safer financial options? Let's take a look at a really popular alternative to stocks. Ah, yes, the classic sales pitch. You get better returns than a fixed deposit, but you don't have to deal with that scary stock market roller coaster. They sell it as the perfect, safe middle ground. It's exactly the kind of thing that would appeal to someone like Rajveer's parents. But here's the thing. Safe is probably the last word you should use. Debt funds are hiding at least 3 huge risks. First, there's interest rate risk. If the fund manager bets wrong on where rates are headed, your returns get hammered. Second, credit risk. The fund is lending your money out. If one of those companies goes belly up, well, so does your money. And third, liquidity risk. Think of it like a fire in a crowded theater. If everyone panics and rushes for the exit at the same time, not everyone's getting out. If investors all try to pull their money at once, the fund might not be able to sell its bonds fast enough to pay you. These aren't just little risks. They can freeze your money solid.
Okay, so we've busted some of the biggest myths out there. Gold isn't the best protector, real estate isn't a great grower, and debt funds are way riskier than they look. So what on earth is the answer? Let's pivot to the solution.
If you only remember one thing from this whole explainer, please make it this. The real secret to building wealth isn't about chasing the biggest returns or finding the next hot tip. It's actually the complete opposite. It's about playing defense. It's about systematically, deliberately crushing risk.
Now, when it comes to stocks, which the data shows have the best long-term potential, it all boils down to asking 4 simple questions about any company. First, can I actually trust their financial statements? That's accounting risk. Second, will people still be buying what they sell in 5 years? That's revenue risk. Third, could another company just swoop in and steal all their customers? That's profit risk. And finally, if I need my money back tomorrow, can I sell this stock easily? That's liquidity risk.
And this all comes together in a really clear, actionable framework called the consistent compounding formula. It's built on 3 pillars you just can't compromise on. First, you only invest in companies with clean accounts that you can trust completely. Second, you find businesses that have a powerful competitive advantage, like a deep moat around a castle that protects them from rivals. And third, you make sure they have a great track record of smart capital allocation, which just means they're really good at investing their profits to grow the business even more. That's it. That is the formula.
So, as we finish up here, I just want to leave you with this one question to think about. I mean, really, think about it. Take a hard look at your own investments, your own beliefs about money. Is your wealth built on those same old damaging myths that trapped Devika and Rajveer? Or are you building your future on a solid, risk-crushing formula?
You know, when we think about investing, we usually focus on picking the winners, right? But what if the real secret to building wealth isn't just about finding the next big thing, but about getting really, really good at avoiding the landmines? Today, we're going to open up the books and find those warning signs that are often hidden in plain sight. Let's learn how to spot these financial bombs before they go off.
And Warren Buffett, he just nails it, doesn't he? The biggest heists in financial history, they're not happening with a gun. They're happening quietly, in spreadsheets and annual reports, a lot of times right under our noses. And look, we're not talking about simple mistakes here. We're talking about flat-out deception, and investors are the ones who pay the price. Okay, so take a look at this number. 40%. What do you think that could be? Any guesses? It's not some amazing stock return, I'll tell you that. It's a number that, honestly, it should make every single one of us stop and think.
Yeah, that's the percentage of top companies on a major stock index that basically vanished from it within 10 years. And not because they got bought out, but because they imploded. On their way out, they absolutely destroyed a massive amount of shareholder money. And get this, these weren't some tiny obscure penny stocks, no way. These were the big guys, the market leaders.
So what does it actually look like when one of these superstars just implodes? We're about to see how some of the companies you thought you could trust can literally turn to dust. And spoiler alert, it's not pretty.
I mean, if you were to draw up a picture of a safe bet, Satyam Computers would have been it. Seriously, this was an IT giant, a total darling of the stock market, and it had the stamp of approval from one of the world's top accounting firms. On the surface, everything, and I mean everything, screamed credibility.
But when the truth about Satyam's fake accounts finally came out, kaboom! The stock dropped 78% in a single day. And that's the thing, this is what happens when the music stops. Just look at these charts for other companies that went down a similar path. The drop isn't some gentle slope, it's a cliff. When the fraud is revealed, the collapse is sudden, it's brutal, and it leaves you, the investor, with absolutely no time to get out.
And listen, Satyam wasn't a one-off, not even close. This was a pattern. Just look at the carnage here. 94% gone for 63 Moons, 99% for Edgecomp and Lanco. I mean 99%. These were superstar stocks that basically vaporized their investors' money. This is exactly the kind of landmine we're trying to avoid.
So how could you have possibly seen this coming? Well, it often boils down to this one simple idea: profits versus actual cash. Think of it like this. A company can say its profit bucket is overflowing, right? But if you look over at its cash bucket and it's empty, or worse, it's got a hole in it, you've got a massive problem. Take a company like Ricoh India. They reported tens of crores in profit, but at the same time, they were burning through hundreds of crores in cash. That huge disconnect? That is one of the biggest, brightest red flags you will ever find.
Okay, so, faced with all this, how in the world do we protect ourselves? Well, it's not about guesswork or getting lucky. It's about having a system, a framework. Think of it as your own personal forensic toolkit for investing.
And here it is. It's a powerful 3-level check, kind of like a funnel. First, we cast a really wide net with a quantitative screen. This is all automated, just looking for weird statistical anomalies. For any companies that make it through that, we move to level 2, a deep dive. We're talking reading the financial statements line by line, page by page. And finally, for the few that are left, we do integrity checks on the people running the show. It's a tough process, but it's designed to filter out all the junk.
So level 1, that's our automated first line of defense. The model uses a bunch of key financial ratios to ask some really important questions, like, hey, is the cash you're generating from your business keeping up with the profits you're claiming? If not, maybe those profits are just paper profits. We also look for stuff like unusually high spending on equipment or buildings, which can sometimes be a way to, well, let's just say move cash around. This first screen is so powerful it knocks out almost 40% of companies right off the bat. But does this screening actually work? Oh yeah, just look at this chart. The model grades companies from D1, which is the cleanest you can get, to D10, the absolute worst. We call the good guys the zone of quality and the bottom feeders the zone of thuggery. And the results? They speak for themselves. Over 5 years, the zone of quality demolished the zone of thuggery, outperforming by a massive 7% per year. The takeaway is simple. Clean accounts and good returns go hand in hand.
All right, so this framework sounds awesome in theory, right? But let's put it to the test. Let's see how it works in the real world. We're going to apply it to the spectacular collapse of a company that had been around for over 250 years, Cox & Kings. The history of this company is just wild. It started way back in 1758. It survived centuries, had a big IPO in 2009, and everyone saw it as this respectable travel giant. But then, in 2011, it made this huge acquisition, taking on a mountain of debt to do it. And just 8 years later, poof, a 260-year-old company was gone.
And here's the craziest part. While the rest of the market saw this 250-year-old blue-chip stock, our forensics model saw something completely different. It was consistently slapping Cox & Kings with a D10 score, the absolute worst rating it can give. For years, the numbers were practically screaming that something was fundamentally broken. So, what did the model see that pretty much everyone else missed?
Well, for starters, a ridiculously complicated corporate structure. I mean, just look at this web of companies. Whenever you see this kind of tangled mess, you have to ask yourself a question. Is this really for a legitimate business reason, or is it designed to make things confusing, to hide where the money is going? 9 times out of 10, it's the latter.
And second, we see that same old classic red flag we talked about earlier, a huge gap between the profits they were reporting and the actual cash they were bringing in. For 8 years straight, the company only managed to turn about 60% of its reported profit into real, actual cash. Again and again, the story is the same. The profits looked great on paper, but the cash just wasn't there.
And then we have the smoking gun. In its last full year of operations, an absolutely unbelievable 92% of the company's standalone revenue came from deals with its own related companies. It was basically just shuffling money from one of its own pockets to another to create this illusion that the business was booming. The point is, all of these red flags, they weren't hidden in some secret vault. They were right there in the financial statements for years.
So you have the complex structure, the profit-cash gap, the shady related party deals. The signs for Cox & Kings were all there. So let's boil all of this down into a simple, practical checklist that you can use to protect your own investments.
First up, is the cash actually flowing? Remember Ricoh and Cox & Kings? Paper profits are a huge warning sign. Second, who are they really doing business with? If you see massive deals with a company's own subsidiaries, that can be a way to just invent revenue out of thin air. 3, is their corporate structure a total mess? Complexity loves to hide the truth. 4, is there a revolving door? Are auditors, CFOs, or board members quitting all the time? Honest people generally don't stick around a sinking, crooked ship. And 5, are they making weird, super expensive acquisitions? This can be a sign of desperation or a way to cover up problems in their main business.
Look, a company's real story isn't just in its slick press releases or its grand vision for the future. The real story is told in the numbers. And learning how to read those numbers for signs of trouble, well, that isn't just a defensive move. It's one of the most powerful offensive tools you can have as an investor. So the real question is, before you buy your next stock, are you willing to pop the hood and see what's really going on in there?
You know, investing in financial companies, it's a really high-stakes game. If you get it right, the returns can be absolutely extraordinary. But if you get it wrong, you can lose everything. And the difference? Well, it often comes down to just one thing: the quality of their accounting. Understanding that is the key to protecting yourself.
The legend himself, Warren Buffett, said it best. Accounting is the language of business. It's how a company tells you its story. And to be a successful investor, you really have to be fluent in that language.
So, what happens when companies use this language not to inform you, but to deceive you? When the story they're telling is just a carefully crafted fiction designed to hide a pretty terrifying reality?
Well, it happens a lot more than you'd think. In India, for instance, some studies suggest that around 70% of banks and non-banking financial companies, or NBFCs, have poor quality accounting. Let that sink in. 70%. That is a staggering amount of risk hiding in plain sight.
And that's the million-dollar question, isn't it? How can you, as an investor, look at a company's financials and tell the difference between the honest storytellers and the expert liars? Well, in this explainer, we're going to give you the tools to do exactly that. Okay, first, we need to understand the battlefield. For lenders, the quality of their accounting isn't just some small detail. It is everything. It literally predicts their fate and the fate of your money.
You can actually map this whole battlefield into 3 distinct areas. First, you've got the zone of quality. This is where the well-run companies with clean books live, and they deliver solid positive returns. Then there's the zone of opacity. Here, things get murky, the accounting is a mess, and returns, predictably, turn negative. And finally, you have the most dangerous area, the zone of thuggery. This is where shady accounting practices are used to just consistently destroy shareholder wealth.
And the difference between these zones? It's not small. Between 2016 and 2020, the good guys in the zone of quality outperformed the bad guys in the zone of thuggery by a massive 33% per year, on average. That right there is the price of poor accounting.
So here's the crucial point. With these dodgy companies, it is not a gamble, it's a ticking time bomb. The collapse is inevitable. The only real question is when it's going to go off.
So how do we defuse the bomb? How do we see the danger before it's way too late? Well, we need to become financial detectives. And every good detective needs a toolkit.
Our number one tool is forensic accounting. Now, this isn't about just reading the numbers. It's about interrogating them. It's about looking for clues, for inconsistencies, for any red flags that reveal the story the company is trying so hard to hide.
So here are some of the key gadgets in our toolkit. And these aren't complicated formulas. They're simple checks that work like a magnifying glass. For instance, high fee income can be a huge red flag. Why? Well, it often means the lender is going after desperate, high-risk borrowers who can't get loans anywhere else and are willing to pay massive upfront fees. Treasury income shows how much profit is coming from market trading, not their main business of lending. If that's high, the lender is acting more like a hedge fund, basically gambling with its capital. Contingent liabilities. These are potential, off-the-books debts. If they're huge compared to the company's net worth, a single bad thing could wipe them out. And finally, the auditor's pay. If it's growing a lot faster than revenues, you gotta ask, are they being paid for their silence?
Okay, now let's put our toolkit to the test. Theory's one thing, but seeing this stuff in action is a whole other ballgame. We're gonna open up a case file on a real-world financial collapse, D1 Housing Finance, or DHFL.
The DHFL case is the perfect example of this whole problem. On the surface, the company looked amazing. Between 2013 and 2018, its loan book and profits were growing at over 20% a year. What a great story, right? But our forensic model told a completely different story. It gave DHFL a D10 rank. That's the worst possible score, basically screaming high risk of fraud. So what did the forensics see that the rest of the market completely missed?
The first clues came straight from our new toolkit. DHFL's fee income and treasury income were just off the charts compared to their peers. The high fees, like we just talked about, suggested they were lending to really risky customers. And the high treasury income? That came from some pretty questionable investments, like in their own joint ventures debt funds, which in turn were holding DHFL's own bonds. It was a classic house of cards.
And the red flags just kept building. Next, you see this revolving door of auditors. They were changed 3 times between 2013 and 2019. Healthy companies just don't do this. This kind of pattern suggests that auditors either found something they didn't like and walked, or they were pushed out before they could. And here's the proof of that risky lending. The proportion of these big, chunky, high-risk project loans on their books tripled in just 5 years, jumping from 5% to 15%. This connects right back to that high-fee income we saw earlier. This is where the risk was hiding, right there on the balance sheet for everyone to see.
The governance failures were just as bad. The promoter himself was the chairman of the Risk Management Committee. I mean, the fox was literally guarding the henhouse. There were all these complex deals with related companies, regulatory fines, partnerships with other banks known to have terrible loans. The warning signs were absolutely everywhere.
With a foundation this rotten, the collapse was just a matter of time. So let's look at what happened when that house of cards finally came tumbling down.
The end came swiftly. On a single day in September 2018, the stock crashed 60%. But the truly tragic part is what happened next. As the price was cratering, retail shareholding tripled. Everyday investors, seeing a cheap stock, rushed in. They were doing something called bottom fishing, basically running into a burning building hoping to find a bargain.
But there was no bargain to be found. DHFL eventually went bankrupt. Shareholders were completely wiped out. And the final creditor claims? Over 86,000 crore rupees, a total catastrophic destruction of wealth.
The story of DHFL is a painful lesson for sure, but it is one every single investor has to learn. So what are the key takeaways to protect yourself from the next big disaster?
Here is what you need to remember. First, accounting quality is the single most important factor, period. Second, ignore the flashy headline growth numbers. The real truth is buried deep in the financial statements. Third, use these forensic ratios as your detective's toolkit. They actually work. And finally, never ever fall for the bottom fishing trap. A stock that has already fallen 90% can always fall another 90%.
Ultimately, it all comes down to this. The evidence of fraud or extreme risk is almost always there, hiding in the annual reports, long before a company collapses. The real question is, are you willing to put in the work to find it? We're all looking for it, right? The perfect business. Not just a good one, but a truly incredible one. A business that just seems to grow and grow, creating massive wealth pretty much on autopilot. Well, today, we're going on a hunt for exactly that, the ultimate compounding machine.
The master himself, Warren Buffett, basically gave us the map. He called it a compounding machine. And it's pretty much the holy grail for any investor. See, it's a business that not only makes a ton of money on its investments, but it can keep plowing more and more cash back in at those same crazy high rates. It's a true wealth creation engine.
All right, so let's pop the hood and see exactly what this machine is and how it really works.
But here's the catch, and Buffett is the first to admit it. Businesses like this are ridiculously rare. So that brings us to the million-dollar question. If they're so hard to find, what in the world are we even looking for?
Well, the whole concept is actually way simpler than you'd think. Just picture a pastry chef, okay? She buys an ingredients for $100, bakes a cake, sells it for $150, and pockets a $50 profit. Now she has a choice to make, and this is where it all begins. She can take that $50 and go have a nice dinner, and her little bakery stays the same size tomorrow. Or she can reinvest it, buy more flour, more sugar, maybe even start saving for a better oven. This is the exact same choice every single business faces. One path keeps you small, the other fuels growth. That reinvestment, that's the fuel for our compounding machine.
So how do we measure how good a business is at this? We use a metric called return on capital employed, or ROCE for short. Just think of it like this. For every single dollar the business puts to work, how many cents of profit does it generate? A high ROCE basically means the company has a super efficient money-making engine. So here it is, the magic formula. It's a two-part engine. First, you need a business that's already super profitable, meaning it has a high ROCE. And second, that business needs to have tons of opportunities to plow a big chunk of its profits right back into itself to get even bigger. When you get both of those things working together, you create this powerful, unstoppable cycle of growth.
But hold on. If a business is that good, won't a bunch of competitors just rush in and ruin the party? That is where our next piece of the puzzle comes in, building a defense.
To protect that beautiful, virtuous cycle, the business needs what's called a competitive moat, and it better be a deep, wide one.
This is some kind of durable advantage that keeps all the rivals at bay, so the company can keep earning those amazing returns year after year after year. So, how do you build a moat? Well, a business guru named Sir John Kay gave us the blueprint. It's called the IBAS framework. That stands for innovation, brand, architecture, and strategic assets. These are basically the 4 pillars that hold up a company's fortress.
Let's see what this looks like in the real world. Innovation isn't just about a new gadget. It's about creating systems nobody can copy, like how Asian Paints used tech to completely dominate its supply chain. A brand is way more than a logo. It's about what people aspire to, like how Jockey became the name in premium innerwear in India. Architecture? That's about building one-of-a-kind relationships. Think about the incredible bond Pidilite has with carpenters. And finally, strategic assets are those exclusive advantages like patents, or in the case of Divi's Labs, the decades of trust they've built with giant pharma companies.
Now, this all sounds pretty straightforward, but it's really easy to get fooled. So let's talk about one of the biggest myths when it comes to finding a great business.
You'd think, right? If a company controls, say, half the entire market, it must have a powerful moat. It must be a fantastic business, but not so fast.
This is the perfect example of that trap. Just look at airlines and telecom companies. Firms like Indigo and Bharti Airtel have enormous market shares, but their customers couldn't care less about loyalty. They just want the cheapest price. In airlines, you just pick the cheapest flight. In telecom, you switch carriers for a better deal. And what's the result? Their revenue per customer is either flat or in some cases, it's actually gone down. They're dominant, sure, but they have zero pricing power.
And hey, this isn't just for service companies. Even a brand that's a global household name like Colgate is practically another word for toothpaste, has to constantly fight off rivals who are willing to sell for cheaper. That massive brand doesn't stop them from getting into brutal price wars that just crush their profits. A strong brand alone is not enough.
So, if owning the market and having a famous brand isn't the whole story, what is? What do the truly legendary companies do that's so different? Let's open up their playbook.
Yeah, the real question is, how do these truly special companies operate? They don't just sit there defending their castle. No, they are constantly on the attack, actively trying to make their moat even wider.
And the strategy they use is just fascinating. Instead of simply solving a problem in their industry, they first make the problem harder for everyone else. For instance, instead of just making paint, they build this incredibly complex, tech-heavy distribution network that a smaller company could never hope to build. They keep adding these layers of difficulty, reshaping the entire industry to their advantage. And then they offer a solution that's so tied into their unique system that competitors just can't copy it. It's brilliant.
The undisputed master of this playbook is Asian Paints. For more than 70 years, they have kept up this incredible growth and profitability by just continuously reinventing the paint industry, from how it's distributed, to the tech they use, to how they serve their customers.
And what was the result of this relentless, brilliant strategy? Well, 1 rupee invested in Asian Paints back in the year 2000 became 150 rupees by 2020. That is the awesome power of a true compounding machine.
But, and this is a huge but, here's the final and maybe most important piece of the puzzle. Finding one of these companies isn't a one-and-done deal. You have to constantly make sure it stays great.
You know, Buffett said the thing that worried him the most was management getting arrogant or just plain bored. Greatness is not a permanent title. The single biggest threat to any compounding machine is complacency. The second a company stops innovating and defending that moat, it starts to crumble.
So we have to keep applying what's called a lethargy test. It's like a regular health checkup. You have to keep asking, is this company still digging its moat deeper? Is it using chaos and crises to get stronger? Is it actually changing as its customers change? And the big one, is it still investing its money wisely, or is it getting distracted by shiny new objects? These questions tell you if the machine is still humming.
And that leaves us with one final big question. As you look around at the corporate giants of today, ask yourself this. Which of them is really still widening their moat, and which one is just coasting on fumes? Which one do you think will be the first to fail its lethargy test? The answer might really surprise you.
Have you ever wondered why 2 companies in the exact same industry with almost identical products can have such wildly different futures? One becomes this incredible investment while the other just fizzles out? Well, it's not luck. It's all about one critical skill the CEO has, a skill that most people never even think to look at. Let's get into it. So here's the game plan for this explainer. First up, we're going to reveal what this hidden job of the CEO actually is. Then, we'll look at the engine that powers a great company. It's all about the cash. We'll give you a simple framework to judge a company's big moves. And of course, we'll dive into some real-world stories of absolute masters and total disasters. We'll also talk about the ultimate resource a company has to allocate. And trust me, it's not money. Finally, we'll wrap it all up with a simple checklist you can use yourself. All right, so let's pull back the curtain. What is this all-important hidden skill? It's something called capital allocation. Now, that might sound a little jargony, but it's actually super simple. It's just about what a CEO decides to do with the company's profits. And believe me, it is the single most important job they have. This quote from William Thorndike Jr. just hits the nail on the head. You can have two businesses that are making the exact same amount of money, but what they do with that money, well, that changes everything. That one decision can be the difference between creating incredible wealth and, well, destroying it. So that really brings us to the core mystery we're trying to solve here. How on earth does one company create a fortune for its investors while its twin, right next door, just sputters out? The answer, as it often does, starts with following the money. To really get to the bottom of this, we need to understand the fuel that powers these corporate engines. We're talking about something called free cash flow, and more importantly, how the best CEOs put that fuel to work. Okay, free cash flow. Let's make this really simple. Think about your own paycheck. After you pay your rent, your groceries, your bills, all the stuff you need just to keep your life running as is, the money you have left over, that's your personal free cash flow. It's the same for a company. This is the extra cash they have to play with, to grow the business or give back to the people who own it. You can kind of picture it like a waterfall. At the very top, you have all the money the company earns. As that money flows down, chunks of it get taken out for things like taxes, day-to-day operations, and just maintaining the equipment. The cash that makes it all the way to the pool at the bottom, that's the price. That's the free cash flow. And this is where the magic happens. The true masters of capital allocation take that prize money and they put it right back to work. They use it to make their business even stronger, which lets them generate even higher profits, which means, you guessed it, even more free cash next time around. It creates this amazing, powerful loop, a virtuous cycle of success. Okay, that all sounds great, but how can you or I tell if a CEO's big plan is going to supercharge that cycle or just break the whole machine? Well, let's build ourselves a little toolkit so you can analyze any company's strategy. This might look a little technical, but it's actually a really simple map called the NSF matrix. It just helps us understand a company's growth plan. It asks two basic questions. Are we selling our existing stuff or something new? And are we selling to our current customers or trying to find new ones? As you can probably guess, the safest place to be is that top left box, selling more of what you're good at to the people who already know and love you. Which brings us to the danger zone, that bottom right box, diversification. This is when a company tries to launch a totally new product into a market it knows nothing about. It's like playing a sport with a double handicap. You don't know the game and you've never used the equipment. This is where companies so often go to die. So this gives us two really crucial questions to ask anytime a company announces a big move. First, where on that map are they playing? Is it a safe bet, or are they venturing into the danger zone? And second, just as important, how big is the bet? I mean, are we talking about a small reversible experiment, or are they literally betting the entire company on one risky roll of the dice? All right, enough with the theory. Let's see how this stuff actually plays out in the real world with real money on the line. This is where it all comes to life, with some incredible stories of success and some truly epic failures. So let's look at a tale of two companies. On the disaster side, we have Tata Steel. Back in 2007, they made a gigantic debt-fueled bet, buying a European company called Chorus, a new market, a slow-growth industry. Then you have the master, Pidilite. They made a bunch of smaller acquisitions, paid for with cash they already had, all in businesses they already understood. And for Tata Steel, the result was just brutal. Take a look at this chart of their profitability. That big acquisition happened around 2008, and you can see what happened immediately after. The company's ability to generate returns just fell off a cliff, and it stayed down. They bet the house, and the house crumbled. And Pidilite, the master? Well, during a similar period, every single rupee invested in them grew to become more than 142 rupees. 142 times. I mean, that is the mind-blowing power of getting this one thing right. And look, Tata Steel isn't alone. This is a graveyard of companies that fell into that diversification trap. Videocon went from appliances into telecom and oil. The UB Group went from liquor to airlines. Every single one of them strayed way too far from what they were good at, made huge bets, and the outcome, well, you can see it for yourself. It was a disaster. Now, we've been talking a lot about financial capital, about money, but the truly, truly great companies, the ones that last for generations, they understand that the single most important resource they allocate isn't cash at all. I love this quote from John C. Maxwell. A leader's lasting value is measured by succession. Think about that. The ultimate act of capital allocation is about people. It's about making sure the company is so strong, so well run, that it can keep winning long after the current star CEO is gone. So how can you spot a company that gets this right? You ask questions. Is all the power in one person's hands, or is it spread out? Do they have a deep bench of talented leaders who have been there for a while? And do they have a history of smooth handovers from one CEO to the next? A company like Asian Paints is just a masterclass in this, seamlessly transitioning leaders for decades.
Okay, that was a lot, I know. So let's boil it all down. We're going to pull every one of these ideas together into one simple, practical checklist you can use on any company you're looking at. Here it is, your 5 essential questions. First, does the company gush cash? Second, does it reinvest that cash smartly to make itself even stronger? Third, are its plans for growth focused and sensible? Fourth, are its big bets carefully measured, or are they crazy all-in gambles? And finally, is this company built to outlast any single person? If you can confidently say yes to these questions, you might just be looking at a true master of capital allocation. So I'll leave you with this one final thought to chew on. The next time you look at a company, try to see beyond the cool products or the latest headlines. Ask yourself, what is this company's real business? Is it just making widgets, or is it a finely tuned machine for compounding capital over the long run? Because seeing that difference, that's the real secret to investing.
Okay, let's talk about it. Let's tackle the one question that drives every single investor crazy, the one that ties even the pros up in knots.
This is it, right? The big one. You've done all the work, you found a company you really like, but then you freeze. Is now the perfect moment? What if I buy today and it drops tomorrow? This hunt for the perfect entry point, trust me, it's something every single one of us has gone through.
But what if the whole game is rigged against you? What if the very question you're asking is the wrong one? The legendary founder of Vanguard, John Bogle, he nailed it when he said this: "There's no magic bell that rings at the top or the bottom." And you know what? This one idea, it pretty much turns conventional investing wisdom on its head. It's the first big myth we need to take down.
So let's dive right in. We all hear it. Buy low, sell high. Sounds so simple, doesn't it? But this chase for the perfect moment can be, well, a total disaster. Believing you can consistently time the market is probably the single most dangerous myth out there. I mean, just think back to early 2020. It really felt like the world was falling apart, and the stock market sure acted like it, dropping a whopping 38%. The logical thing to do seemed to be to sell, right? Get out, wait for things to calm down. But the market hit its absolute bottom on March 23rd, and then, poof. In just 49 trading days, it rocketed back up 32%. Anybody who panicked and sold not only cemented their losses, they completely missed one of the fastest recoveries ever. It's a pretty brutal and very recent lesson.
Okay, but what does the hard data say? Let's look at a 30-year study of the Indian market that compared 2 investors. The first one is a genius, an absolute wizard. They managed to invest at the market's lowest point every single year for 30 years. Their return? 12.8% a year. The second strategy? Super simple. Just invest on January 1st, every year. No thinking, no stress. That returned 12.1%.
So what was the grand prize for being a perfect, once-in-a-generation market timer for 3 decades? A measly 0.7% extra per year. Think about that. All that impossible skill for a reward that's barely noticeable. The effort just isn't worth it. Let me make this even more obvious with a quick story.
Let's imagine 2 investors. They take completely, and I mean completely, opposite paths. So on one side, we have Mr. Gifted,
This guy has a superpower. He can somehow, magically, pick the single worst day of the year for a stock every year, and that's when he invests his money. And on the other side, we have Mr. Mortal. He's basically us. He just picks a day, let's say January 1st, and invests his money like clockwork, year in, year out, no matter what. And they both decide to invest in the same company, Nestlé India.
So, after a full decade of this experiment, look what happens. Just look. The gray line, that's our perfect timer, Mr. Gifted. The darker line, that's Mr. Mortal, just consistently plugging away. It's almost unbelievable, but their final results are shockingly close. Even with his supernatural ability to buy at the perfect bottom every single year, Mr. Gifted is barely ahead. Let's put a hard number to it. After an entire decade of flawless timing, Mr. Gifted's annual return was only 1.9% higher than Mr. Mortal's. So even when you zoom in on a single stock, perfect timing gives you a tiny, almost insignificant edge. This actually brings us to the second big myth that trips investors up.
So if it's not just about when to buy, what about at what price? We're always told to avoid stocks that look expensive, and the number one metric for that is the price-to-earnings ratio, or PE. But can that little number actually be really, really misleading?
The common wisdom, right? A high PE is a big red flag. It means a stock is overvalued and you should stay away. But let's actually put that theory to the test with an amazing real-world example, the story of Asian Paints. Let's hop in a time machine back to 1996. Asian Paints was trading at a PE of 26. Now that was double the market average at the time. By every definition, it was expensive. But then, something incredible started to happen. Over the next 10 years, its cash flow grew by almost 21% per year. And then, get this, it actually accelerated over the next 15. So what was the final result? An investor who bought that wildly expensive stock back in 1996 made a staggering 23% annual return for the next 25 years.
And here's the lesson. A static little snapshot like a PE ratio, it just can't see the future. It can't capture the incredible power of a truly great business to keep growing and growing for decades. It misses the most important ingredient, longevity. So if timing is a myth and simple valuation is misleading, where does that leave us?
Well, the real answer isn't about timing or price. It's about shifting our focus to a much more powerful and, frankly, more reliable quality, consistency.
So let's add a new term to our playbook, consistent compounders. These are not your average companies. No. These are the all-stars, the elite businesses with deep, powerful advantages that let them crank out positive cash flow, not just for a good quarter or a good year, but decade after decade. This is the kind of quality that PE ratio for Asian Paints just couldn't see. And look, this isn't just some nice-sounding idea. The data backs it up big time. A study of over 300 stocks found a direct link between cash and returns. The companies that were cash-generating machines, the ones with positive free cash flow in at least 7 out of 10 years, they delivered an average annual return of 15.3%. Now, compare that to the companies that were always struggling for cash. They returned just 4.7%. The evidence is just crystal clear. Consistency is what drives long-term returns.
So after busting these two huge myths, what's the big idea? What's the one thing you need to remember? Let's bring it all together.
First and most importantly, forget about trying to time the market. It's your time in the market that builds real wealth. Second, you have to look past simple numbers like PE. The true value is in the long-term quality and staying power of a business. Third, your new mission, should you choose to accept it, is to hunt for these consistent compounders. And all of this leads to the most important shift in mindset you can make. Stop asking, when should I buy? And start asking, what should I buy?
And that's really the question that matters most. Are you still looking for the right time, or are you ready to start searching for the right company? Because shifting your focus from the ticking of the market clock to the enduring quality of a business, well, that is the most powerful change you can make as an investor. Thanks for joining me.
So a lot of us try to do the right thing with our money, right? We work hard, we save what we can. But what happens when you do that for years, you look at your account and you're not really getting anywhere? It feels like you're just treading water. It's a super common feeling, and today, we're going to look at a way to build a real plan to change that. Does this question kind of hit home for you? If you feel like you're checking all the boxes, saving, being responsible, but that real financial growth just isn't happening, you are definitely not alone. But here's the good news. The problem isn't that you need to save harder. It's that you need to plan smarter.
All right, to really get what I mean, let's dive into a real-world story. I want you to meet Devika. She's the perfect example of someone who did everything right for decades, but still felt like the whole financial system was just, well, rigged against her. I mean, for 2 whole decades, Devika was the model saver. She worked, she put money aside, but you know that magic of compounding everyone talks about? For her, it just wasn't kicking in. And as you can see, the clock was ticking. Her window to build a comfortable retirement was getting smaller and smaller. And the stakes here were incredibly high. She had a net worth of 9 crore rupees. That's a lot of money. But to keep her lifestyle going in retirement, which was only 10 years away, she needed to more than double it, all the way to 20 crore. That meant her investments had to grow at 9% after taxes year after year. That is a huge, huge mountain to climb. So, feeling pretty overwhelmed, Devika went to an expert advisor, a guy named Vishnu. And what he suggested wasn't some complicated, risky scheme. It was actually a simple but really powerful new way of thinking, a 2-bucket investment plan. This was going to be her blueprint. So let's break this down, because it's actually genius, not just in how simple it is, but in the psychology behind it. Bucket number 1 is the rainy day pot. He put 4 crore in super safe government bonds. This is for emergencies, for anything that comes up. Knowing that money is safe stops you from panicking. Then, bucket number 2, the growth pot, gets the other 5 crore. That money goes into a carefully picked portfolio of top-quality stocks, and you can let it grow without that fear of needing to sell it at the worst possible time. But, the second Vishnu said the word stocks, a wall went up. Devika was like, no way. She'd heard all the horror stories from her friends, seen people lose everything, and her reaction is probably what a lot of you are thinking right now. Isn't the stock market just one big casino? And this is where it gets really, really interesting. Instead of just arguing, Vishnu decided to fight her doubt with cold, hard data. He started to break down all those common fears about the market, showing her that what we think is risky isn't always the reality. So he started with this chart of the Sensex. Think of it like the S&P 500 for the Indian stock market. And honestly, at first glance, it kind of proves Devika's point, right? Sure, it goes up about 2/3 of the time, but the results are all over the place. A huge gain one year, a nasty loss the next. It looks totally random, and that randomness is exactly what terrifies most people. But then, Vishnu showed her this, and this is the aha moment. On the left, you see the messy, chaotic returns of the whole market. But on the right, those are the returns of just one high-quality company. I mean, just look at the difference. The market average gets dragged down by all the mediocre companies. But when you just focus on the great ones, the picture changes from random noise to something, well, remarkably consistent. And the numbers here really tell the story. Get this. A quality company like the one we just saw, it has positive returns 80% of the time. That's 4 out of every 5 years. And when it has a good year, it's often a great year, with returns over 30%. And that one bad year, it's almost always followed by a massive comeback. See, this isn't gambling, it's a pattern. Okay, now this chart right here is the real mythbuster. This shows you rolling 3-year returns. Basically, it answers a simple question. If you invested in these quality stocks and just held on for 3 years, what would have happened? The answer is staggering. Over the past 2 decades, you would have almost never lost money. This is how quality and time work together to smooth out all that scary short-term noise and turn it into long-term predictability. Now, you might be thinking, okay, I get it. That works for big, safe companies. But what about the really risky parts of the market? Well, to answer that, let's meet our next case study, Rajveer. He's a totally different kind of investor. So Rajveer was an investment banker. He was young, he was smart, he knew his way around finance. But he had already lost a ton of money by basically gambling on small cap stocks. These are those smaller, younger companies that can either explode in value or completely flame out. He was scarred from the experience, and he was totally hostile to the idea of ever touching them again. And you know what? You can't blame him. Small cap investing is a world of absolute extremes. On one side, you have companies that create staggering, life-changing wealth. But on the other, you have companies that will just completely vaporize your money. There's almost no middle ground. This chart shows you the brutal, honest truth. Just look at the bars on the far left and far right. The absolute best small companies, they returned an unbelievable 96% per year. But the worst, they lost almost half of their value every single year. The message here couldn't be clearer. In this part of the market, picking the right company isn't just important,
It is absolutely everything. So, what do we learn from Devika's fear of the market and Rajveer's painful small cap experience? Their stories are different, but the lesson is exactly the same. You have to have a blueprint. A systematic plan is what separates real investing from just plain gambling. So here it is, the blueprint, boiled down to 3 simple steps. First, secure your base. This is your rainy day money, and it goes into something ultra safe, non-negotiable. Second, choose your growth engine. This is the rest of your money, and it goes into a portfolio of stocks that you've deeply researched, not just heard about. And third, and this is the most important part, insist on quality. Become obsessed with finding businesses with clean books, smart leaders, and a real durable edge over their competition. So, as we wrap this up, I really want to leave you with this one question to think about. When you look at your own financial situation, what do you see? Is it a carefully designed blueprint built on solid principles? Or is it just a collection of hopes, fears, and bets? The answer to that question might just change your entire financial future. Today, we're talking about a true cricket legend, Rahul Dravid. But this is so much more than just a sports story. What we're really going to do is unpack his entire method, his whole philosophy, to find a blueprint for greatness. And I mean greatness in anything: your job, your personal life, even your investments. And really, to get to the heart of what made Dravid Dravid, you've got to start right here. Sanjay Manjekar said he had the strongest mind. Just let that sink in. The strongest mind. That's the whole game right there. See, this isn't a story about some kind of raw natural talent he was just born with. Nope. This is about something that was built, something he worked on every single day. Just incredible mental strength. And that brings us to the big puzzle, doesn't it? When you look at his methods, they seem, well, simple. Almost boringly simple. Play a straight bat, stay fit, don't do anything crazy. It's textbook stuff. So, if it's so straightforward, why isn't everyone Rahul Dravid? Why is he so hard to copy? Well, the answer isn't really about cricket at all. It's about psychology. And it all breaks down into 4 key pillars. All right, pillar number 1, practice. Now hold on. Before you say, duh, of course practice matters, let me stop you. We're not talking about just, showing up and hitting a few balls in the nets. Dravid's idea of practice was something else entirely. It started when he was just a kid, 8 years old, and it was on another planet. So, that famous 10,000-hour rule from Malcolm Gladwell, right? The idea that it takes that long to become a true expert at something? Well, get this. By the time Dravid put on his Indian test cap for the first time, at just 23 years old, he had already blown way, way past that 10,000-hour mark. But here's the kicker. It wasn't just about the amount of time he put in. It was about the kind of practice he was doing. And this is how he did it. Think of it as a 2-front war he was waging. On one side, you've got the pure physical grind, the relentless net sessions where he treated every single ball like it was the last ball of the World Cup final. But then, on the other side, you have this constant mental game, the shadow practice at home, visualizing bowlers, mapping out scenarios in his head. And for him, one was just as critical as the other. His old coach, John Wright, he saw this firsthand. He said it was just incredible to watch. For Dravid, practice wasn't just about hitting balls for an hour. It was about competing. He was always competing. He absolutely hated getting out, even if it was just in the nets. And that right there, that's how you forge the kind of mental and muscle memory that holds up when the pressure is screaming in your ear. And that mental side, wow. This story from his wife, Vajita, just says everything you need to know. She actually called his shadow practice an obsession. He was doing it all the time, at all hours. That just shows you how deep this stuff ran. It wasn't homework for him. It wasn't a chore. It was just who he was. It was like breathing. So all that practice, both physical and mental, it wasn't just about sharpening his skills. It was building something bigger. And that leads us to our second pillar, building a mental fortress. I love that term. This is all the work nobody sees, the behind-the-scenes stuff, the routines that created that legendary calm he had when everything was on the line. And here's the thing, this wasn't some new strategy he developed when he became a professional. His childhood teammate, Fazal Khalil, remembers him creating this zen-like atmosphere around himself even when they were schoolboys. Think about that. He was quiet, he was meditative, he was laying the foundation for that fortress brick by single brick right from the very beginning. One of his most powerful tools for building this fortress, Visualization. And let's be clear, this is not just daydreaming about hitting the winning runs. No. This was a systematic, structured process. He'd break down bowlers, he'd replay past encounters, especially the ones where he failed, and he would literally plan out how an entire match day should go. In his mind, he had already played the game before he even stepped on the bus. And all of this came together in his pre-match routine, which was just meticulous. I mean, look at this. He would intentionally slow everything down. He'd wake up hours early, he'd never rush breakfast. This wasn't about being superstitious, like wearing lucky socks. This was a deliberate, engineered process designed for one thing, to get his mind into that perfect state of calm focus where he could perform at his absolute peak. Okay, so you've got the insane practice habits, you've built the mental fortress, you're unstoppable, right? Well, what happens when you hit a wall, when you fail? That's where pillar number 3 comes in, and it might be the most important one, having the humility to admit you have a weakness, and then the smarts to actually go and fix it. So let me paint you a picture of the problem he was up against. Early on, he got labeled. He was the test specialist. Solid, dependable, perfect for the long, slow grind of a 5-day match. But for the fast-paced, explosive one-day game, the critics said he was too slow, too defensive. And then he got dropped from the team. For most athletes, that's a career-ending crisis. But for Dravid, it was just another problem to be solved. So what did he do? He didn't complain, he didn't make excuses, he went back to the drawing board and literally rebuilt his batting technique from the ground up. Look at this. He changed his stance from crouch to more upright, he changed the way his bat came down on the ball, and these seemingly tiny little adjustments, they had a massive impact. Suddenly, his arms were freer, he could hit the ball anywhere on the field, and it completely revolutionized his one-day game. And you can boil that whole comeback story down to this incredibly powerful 4-step process. Step 1. Acknowledge the weakness. No ego, no denial. Just admit it. Step 2. Engineer a technical solution. Step 3. Practice that solution relentlessly until it's second nature. And step 4, the hardest part, actually execute it under the crushing pressure of a real game. Sounds simple, right? But man, is it hard to do. And all of this, the practice, the fortress, the humility, it all sits on top of one foundational idea. Our 4th and final pillar, the mindset of a seeker. This is that deep, insatiable curiosity, that growth mindset that just fueled everything he did, on and off the field. I love this quote from Greg Chappell. He said Dravid was like a child because he was always asking questions, always asking why. He wasn't content to just be told what to do, he had to understand the deep reasoning behind it. And that curiosity, that need to know why, is what made him so coachable. It's what allowed him to take a big theoretical idea and actually turn it into something real he could use. And his curiosity was huge. It stretched way, way beyond the cricket field. I mean, the guy was reading To Kill a Mockingbird, he was visiting wildlife parks, he was seeking out visual skills specialists in South Africa, he even went to explore the mind room at Chelsea's football club. You might think, what does that have to do with cricket? Everything. All that cross-pollination of ideas from different fields made him a more creative, more adaptable problem solver when he was out in the middle. Okay, so we've got the 4 pillars: practice, the mental fortress, humility, and a seeker's mindset. Now, let's bring this all home. Because there's a really powerful connection here, a direct line you can draw between the way Dravid operated and the way a truly great investor thinks. Just look at this. The parallels are almost one-to-one. Dravid's relentless practice, that's the deep, nitty-gritty company research an investor has to do. His mental fortress, that's the disciplined, unemotional process you need to have in place to ride out the market's craziness. That humility to improve, that's an investor looking back at their bad calls, learning from them and getting better. And the seeker's mindset, that's the growth mindset you absolutely must have to adapt and survive. It's the same blueprint. And in the end, who better to sum it all up than the man himself? He said, "I have looked at all areas of my game and worked hard on all of them. There was no magic trick, no secret sauce. Success came from working on every single part of the puzzle, the technical, the physical, and the mental. It was, just like he said, a question of getting it all to come together at the right time." So what's the big takeaway here? It's that talent is something you're given. It's a gift. But greatness is a choice. It's a choice you make every day built on discipline and process. The Dravid blueprint, it gives us the map. And so it really leaves just one question for all of us to think about, not just in sports or investing, but in anything we do. What part of your process are you going to work on today?
Let's be honest, trying to find a truly great company on the stock market can feel, well, overwhelming. There are thousands of them out there, and it is so easy to get lost in the noise. But what if I told you there's a simple, powerful tool you could use, a way to cut through all that confusion and really separate the future winners from the ones that are just destined to fail? That's exactly what we're going to build today.
You know, this whole idea actually comes from a pretty surprising place, an operating room. The surgeon Atul Gawande found that for even the most brilliant, experienced experts, a simple checklist dramatically reduced mistakes. And it's not because they lack skill, right? It's because when things get complicated, even the smartest among us can miss one crucial step. And if there's one thing we know about investing, it's that it is absolutely complicated.
So how does something a surgeon uses apply to your finances? Well, think about it. Investing is another high-stakes game where one simple mistake can be incredibly costly. The real power of a checklist is that it forces you to be disciplined, to be systematic. It's a shield that protects you from your own emotional biases and all that market hype that's constantly being thrown at us.
I want you to start thinking of yourself as a doctor giving a company a complete physical exam. We're going to do a 3-part checkup. First, we'll check its vitals to see if it's healthy right now. Then we'll assess its immune system to see if it can fight off future threats. And finally, we'll judge its brain to see if it's making smart decisions. This gives us a complete picture of a company's health long before we even think about putting our hard-earned money into it.
All right, first things first. Before we fall in love with a company's cool products or its inspiring story, we have to know one thing. Can we actually trust its numbers? This is our baseline. Are the vital signs, the profits, the sales they're reporting, are they even real?
So here's where you put on your detective hat. This is the first, most crucial test. Profit on a piece of paper is completely different from actual cash in the bank. Our job is to follow the money. A company can claim to have huge profits, but if it's not actually collecting cash from its customers, that is a massive red flag. It could be a sign that the whole business is built on shaky ground.
Okay, so here are 3 specific clues you need to hunt for. First, look at cash flow versus profit. If profit is way up here, but cash flow is way down here, it might mean they're booking sales that they haven't gotten paid for yet. Not good. Second, check how much the auditor is getting paid. If their pay is growing way faster than the company's revenue, you have to ask yourself why. Are they being paid extra to, look the other way? And finally, you've got to look for contingent liabilities. Think of these as hidden time bombs, like a giant lawsuit just waiting to explode and wreck the balance sheet. These little checks help you see what's really happening behind the curtain.
Okay, let's say a company passes our forensic check. The vitals look strong. Awesome. But, a healthy person today can still get sick tomorrow. So our next question is all about resilience. Does this company have what it takes to survive and thrive for years? Or is it going to get knocked out by the slightest market cold?
And this brings us to what I like to call the company's immune system. This is its competitive advantage. A really strong immune system is what fights off rivals and keeps a business healthy and pumping out profits year after year after year.
You see, the very best companies are always on the attack. They are the disruptors, like this rocket on the left, always launching new things, always finding better ways to operate. They would honestly rather make their own products obsolete than sit around and wait for a competitor to do it for them. You don't want to be the paper boat on the right, just getting swamped by the waves of change.
So, where does this strong immune system come from? Well, it can be a culture of nonstop innovation. It could be a brand that's so powerful, customers will happily pay more for it. Sometimes it's a strategic asset, like a special government license that nobody else can get. Or sometimes it's as simple as being the kind of place that attracts and keeps the absolute best people in the entire industry. But here's the ultimate test, the acid test for any competitive advantage. It's this question. Can the company raise its prices without sending all its customers running to the competition? If the answer is yes, that, my friend, is the sign of a truly powerful moat. It means people value what they offer so much, they're willing to pay up for it. And that's a durable path to long-term profitability.
So far, so good. We've got a company with clean numbers and a strong immune system. The final piece of our puzzle is the brain, the management team. This is all about what they do with the company's money. Are they making smart, disciplined decisions with the cash the business generates?
You'll find that great management follows a pretty logical path. First, they run the main business really well, so it spits out a lot of cash. Then, they have a clear, focused plan for how they're going to grow.
After that, they intelligently pour that cash back into the plan. And this is so important. They're always thinking about the future, making sure there's a strong team ready to take over. You see, it's a journey, not just a series of wild, random bets.
And what does that look like on the outside? Well, we look for signs that the leadership is playing the long game. Is there a real succession plan? Is the board full of independent people who can actually challenge the CEO, or is everything dependent on one genius founder? And you have to check for this. Are they using the company's money to enrich themselves through shady side deals? These are the little checks that reveal the true quality of the company's brain.
And there we have it. Our full body health check is done. We've checked the vitals, we've assessed the immune system, we've judged the brain. Now it's time to put it all together and make our final diagnosis.
So, question number 1, can we trust the numbers? Is the profit they're reporting actually backed up by real cash? This is the foundation. If the answer is no, nothing else matters.
Question 2. Does it have that strong immune system? Is there a protective moat around this business that will let it thrive for years and fend off all those competitors who are constantly trying to take a bite out of it?
And finally, question 3. Is the brain working correctly? Is the leadership team making smart, disciplined decisions that are actually going to grow the value of this business for the long haul?
Now, let's be perfectly clear. No checklist in the world can guarantee you're going to pick a winning stock every single time. The future is always going to be uncertain. But what a tool like this can do is give you a powerful defense. It can help you systematically screen out the weak companies, the fraudulent ones, and the fraudulent ones. And by doing that, you dramatically improve your odds of avoiding a catastrophic loss. And in the world of investing, not losing money is the first and most important step toward winning.
Ever wonder what makes some companies absolute legends, sticking around for decades, while others just fizzle out? Well, it often boils down to this one really powerful idea, a competitive moat. Today, we're going to break down exactly what that means and how you can learn to spot one in the wild.
So, to really wrap our heads around this, let's kick things off with a little puzzle posed by one of the greatest investors to ever live. The legendary Warren Buffett, right? He's the one who really made this idea of a moat famous. He described it as this durable, protective barrier a company has around its profits. But here's the catch, and it's a big one. You can't just plug it into a spreadsheet. You can't punch numbers into a formula and have it spit out the answer. It's about a deep, intuitive understanding of the business itself. It's as much an art as it is a science.
And that's the million-dollar question, isn't it? If a guy like Warren Buffett says there's no simple formula, where do we even begin? What are we supposed to do? Well, don't worry. That's exactly what we're going to tackle right now.
The key to solving this mystery, it turns out, comes from the brilliant work of economist Sir John Kay. He basically created a blueprint, a systematic way for us to think about and identify these powerful but kind of elusive moats.
Okay, so first things first. Let's get a really solid definition, straight from Kai himself. A moat is a sustainable competitive advantage. The key word there is sustainable. This isn't about having one good quarter or a single hit product. It's about having something structural, something built into the company's DNA that stops rivals from eating your lunch over the long haul.
So how does this work? Well, Kay splits it into two big buckets. On one side, you have distinctive capabilities. Think of this as the stuff you can't really touch or see, a company's relationships, its culture. On the other side, you have strategic assets, the tangible things like patents or legal rights. We're going to start by diving into those intangibles.
All right, let's dive into that first pillar, distinctive capabilities. And honestly, this is where you find some of the strongest moats, precisely because they're the hardest things for a competitor to see, let alone try to copy.
And the first one is something we all instinctively get, brand and reputation. You know, when you trust a company, you're just more likely to buy from them, especially if it's something important or expensive. That trust, man, it's a powerful asset and it takes years, sometimes decades to build.
And hey, this isn't just some vague, fuzzy concept. Check this out. What you're seeing here is hard proof. This data shows that the companies with the most trusted brands have delivered returns for their shareholders that absolutely crush the market average. So that brand trust, it translates directly into cold, hard cash.
Okay, building on that, the next big intangible is something Kay calls architecture. This is a cool one. The best way to think about it is like a company's unique nervous system. It's that complex web of relationships it has with its employees, its suppliers, and its customers. It's the secret sauce of how they get things done.
And to really get a sense of how powerful this can be, just look at this number, $23
million liters. That's how much milk the Indian dairy co-op Amul collects every single day from more than 3.6 million different farmers. I mean, it's a mind-boggling logistical feat, and the only way they can possibly pull it off is because of this incredible architecture of trust and cooperation they've built over decades. Here's another fantastic example, this time for manufacturing. India's Maruti Suzuki has a supply chain that is an absolute work of art. Imagine this, more than 270 suppliers are all plugged into their system, delivering parts with just a few hours' notice right when they're needed. A competitor just can't replicate that overnight. You can't. It takes decades to build those kinds of relationships and processes.
All right, the last piece of this intangible puzzle is innovation. Now, a single brilliant idea, it's great, but it can often be copied pretty quickly. The real moat, the sustainable advantage, comes when you have a culture of nonstop innovation that's backed up by a strong reputation and a solid architecture. I mean, just think about a company like Apple. It's not just one cool product, it's a constant stream of new ideas built on a legendary brand and a seamless ecosystem.
So we've seen how powerful that invisible stuff can be, right? Now let's flip the coin and look at the other side of Case Framework, the more concrete, strategic assets. This is the stuff you can actually see and touch. These are the advantages that are like giant brick walls stopping competitors in their tracks. We're talking about things that are incredibly hard or even impossible to replicate. Think about a pharmaceutical company's patent on a life-saving drug, or the famously secret formula for Coca-Cola. Or maybe it's an exclusive government license to operate, or just the massive, massive cost of building something like a national railroad. These are hard assets, and they create a seriously formidable moat. But what does having an asset like that actually mean for the business? Well, this comparison here shows it perfectly. Because Tata Steel has access to its own iron ore mines, a huge strategic asset, its raw material cost is about 23% lower than a competitor like JSW Steel, who has to buy it on the open market. That's a massive, sustainable cost advantage that goes straight to their bottom line year after year.
Okay, so we've got the intangibles, we've got the hard assets. Now let's bring it all together and look at a masterclass in moat building from one of the world's most successful companies, BMW.
And here's the really crucial thing to get. The truly great companies, the ones with the strongest moats, they don't just rely on one single advantage. Their moats are deep and wide because they're built from a combination of factors, all working together, all reinforcing each other.
For BMW, it all starts with reputation. For decades, when you hear that name, you immediately think of high-quality, performance-driven German engineering. That's a powerful perception that a competitor can't just buy or create with a clever ad campaign.
Then you layer on their incredible architecture. BMW has these extremely tight, long-term relationships with its suppliers and its dealers. This gives them insane control over quality from start to finish, and it helps them protect their premium pricing and their brand image all across the globe.
So when you put that rock-solid reputation together with that finely tuned architecture, what do you get? You get an incredibly powerful brand. You see, a BMW isn't just a car. It's a statement. It's a symbol for a very specific type of customer. Now that is a moat that is both incredibly wide and incredibly deep.
So as we wrap this up, I'll leave you with a question. Think about the companies you interact with constantly. The coffee you drink, the phone in your pocket, the software you use at work. Using this framework we've just gone through, can you identify their moat? Is it an intangible capability like their brand? A hard asset like a patent? Or is it a masterful combination of both? Because understanding that, that's the key to cracking the moat mystery. So, let's talk about an investment strategy that honestly feels completely backwards. It's called the coffee can portfolio, and its core idea is that the single best thing you can do for your investments is absolutely nothing. Yeah, you heard that right. Let's get into how that could possibly be true.
You know, the man who dreamed this all up, Robert G. Kirby, he put it perfectly. He said, investing isn't like a sprint where you're trying to win every single day with these frantic, risky moves. No, it's an endurance race. It's all about making smart choices at the start and then just having the stamina to stay on the track and finish the race.
And that really brings us to the central kind of mind-bending question of this whole thing. I mean, what if all the trading, the constant analysis, the buying and selling, what if it's all just noise getting in the way? What if the real secret is just to buy the right companies and then just sit on your hands?
To really get this, we've got to go back to a story from the 1980s.
The name itself, coffee can, is a throwback to the Old West. You know, when people would take their most precious valuables, stick them in an old coffee can, and hide it away for safekeeping. A simple, long-term plan.
So the story goes like this. Robert Kirby, this top-tier investment manager, is sitting down with a client. And he notices that her husband had been following his advice to the letter, putting about $5,000 into every single stock Kirby told him to buy. But here's the twist. While Kirby was busy managing his client's accounts, selling the losers, rebalancing, this guy did something totally different. He followed every single buy recommendation, but he completely ignored all the sell recommendations. He never sold a thing, not one stock.
And after 10 years, what was the result? Well, the husband's do-nothing portfolio had absolutely crushed the one Kirby was professionally managing. Sure, he had a few duds in there, but a handful of his stocks had become monster winners. He had one holding in Xerox that grew to over $800,000. By doing nothing, he just let his winners run, and they made him a fortune.
And boom, just like that, the coffee can portfolio was born. The whole idea is simple. You find a handful of really high-quality companies, you buy their stock, and then you metaphorically lock it away in a coffee can for at least a decade, fighting every urge to peek or to mess with it.
Okay, that's a great story, but it begs the question, how on earth do you find these high-quality companies? Well, this isn't just guesswork. The strategy uses a really specific, really tough set of filters to find the best of the best.
All right, here's the three-step recipe, and we're going to apply it to the Indian stock market. First, you start with companies that are a decent size, so with a total value over 100 crore rupees. Then, from that list, you apply two incredibly strict filters. Let's break those down.
The very first filter is all about consistent growth. The question is, has the company grown its sales by at least 10%, not just last year, but every single year for the last 10 years? No off years, no excuses.
So why that 10% number? Well, if you look at the Indian economy as a whole, it's been growing at about 13% a year. So a really solid company should be able to keep up. Setting the bar at 10% is a really tough but fair test that weeds out the one-hit wonders and finds businesses that can grow steadily, year in and year out.
Now for the second filter. This one is all about profitability. We're looking for a return on capital employed, or ROCE, of at least 15%. And just like the sales growth, it has to hit that mark every single year for a decade.
ROCE is just a fancy way of asking, for every bit of money a company puts into its business, how much profit does it get back out? And that 15% number is key. It makes sure the company isn't just getting bigger, it's actually creating real value. It's earning way more than what it costs to borrow money or just the general risk of being in business. It's the sign of a truly well-oiled machine.
So that's the recipe. It's simple, it's logical. But the billion-dollar question is, does this super strict do-nothing approach actually work in the real world? Okay, this is where it gets really fun. Let's look at the data.
And here is the proof in the pudding. This chart shows what would have happened if you built a new coffee can portfolio each year. Now, just let your eyes drift to that last column, the one called outperformance. That shows you how much the portfolio beat the Sensex, the main benchmark for the Indian market. It's incredible. No matter when you started, this simple strategy consistently delivered better returns, sometimes by a massive amount.
So where is all this extra performance coming from? Well, a stock's return really comes from two places. On one side, you've got reality. That's the company actually growing and making more profit. On the other side, you've got hype. That's just market excitement, how much extra people are willing to pay for a stock because it's popular. The coffee can strategy bets everything on reality and tunes out the hype.
And check this out. The data proves it big time. This table splits the total return into those two buckets. Just compare the numbers from profit growth to the numbers from PE growth. It's not even close, right? In every single case, the vast majority of the gains come from real business success. You're winning because the companies you own are winning, not just because they got trendy for a while.
And this chart, wow, this might be the most powerful idea of the whole thing. It shows the range of possible returns you could get depending on how long you hold on. If you only hold for 1 year, look at that bar on the left. It's huge. You could have a great year or a terrible one. But watch what happens as you hold on longer. By the time you get to the 10-year bar, that range of outcomes gets so much smaller. The chance of losing money practically disappears. Time is your superpower here. It literally reduces your risk.
All right, so we've heard the story, we've got the recipe, and we've seen the proof. Let's make this real. What does a modern-day coffee can portfolio actually look like? Here it is. These are the 7 companies that actually passed those super tough filters back in July of 2020. You probably recognize a lot of these names. They're well-known, high-quality businesses. And the idea would be to put an equal amount of money in each of these, seal that can, and not even think about touching it again until 2030.
So, you see, in the end, the strategy isn't some big secret. The recipe is right here. The data is compelling. The hardest part, the final ingredient, isn't about money or finding the right stocks. It's psychological. The real question is, in a world that is constantly screaming at you to do something, do you have the patience to do nothing?
Okay, let me ask you something. What if I told you that 95% of your hard-earned money is likely tied up in assets that are actually failing to beat inflation? I know, it's a shocking thought, but for most of us, it's the simple truth. Today, we're going to change that. We're going to break down the powerful investment philosophy from the book Diamonds in the Dust. Let's get right into it. You know, the entire idea of this book is captured perfectly in this one analogy. It compares the ideal investment to one of cricket's all-time greats, Rahul Dravid. See, it's not about the flashy shots or taking huge risks. It's all about incredible patience, a rock-solid defense, and just this unwavering determination. This isn't about trying to hit a 6 on every ball. It's about building a winning innings, one that lasts. And really, that's the core of it all. Successful investing isn't some frantic, high-stakes T20 match. No, it's a strategic 5-day test match. And that requires a completely different mindset, one that's totally focused on the long game. Think about it. T20 investing is all about constant action, right? You're trying to hit every single ball out of the park. It's super high risk, and frankly, it often leads to you getting out early. The test cricket approach, on the other hand, is all about patience. It's about knowing which dangerous deliveries or, risky stocks to just leave alone, and instead, building your wealth steadily over time. It's about defense first.
So the big question is, why do so many of us play the T20 game with our money? Well, it's usually because we're guided by these deeply ingrained but really damaging investment myths. So let's just break them down one by one. First up is a classic, one that's probably been passed down through generations in your family. The idea that gold is the ultimate safe haven for your wealth. It's a belief held by millions of people. But you know what? The data tells a very, very different story. I mean, just look at the numbers. They really don't lie. Over the last 30 years, the BSE Sensex delivered an annual return of almost 15%, while gold, it only managed about 9%. The trend is crystal clear. Across every single long-term period, equities have consistently beaten gold. So while gold might feel safe, it's actually costing you a ton of potential growth. All right, the next myth is a huge one, maybe the biggest driver of investment in India. Property. We're always told it's the absolute safest path to building wealth, but is it really? Check out this chart. It shows Indian house prices relative to our income compared to other Asian economies. And as you can see, we are way, way off the charts. What this suggests is that our property market is probably significantly overvalued. And when you add in the high transaction costs and the fact that it's hard to sell quickly, well, real estate suddenly looks a lot less safe than we're all led to believe. Okay, so what about something that at least sounds safer, like debt mutual funds? I mean, they're often sold as this stable alternative, but they come with their own set of hidden dangers. See, to offer those attractive returns, some fund managers have to take on more risk. They might buy bonds from less stable companies, which have a higher chance of, not paying you back. They also face the risk of not being able to sell their investments if everybody starts to panic at once. And on top of that, if interest rates change unexpectedly, the whole fund can lose money. So yeah, they're not nearly as safe as they sound. And here's the final myth, this idea that a growing economy automatically means a rising stock market, and that you can somehow time your investments based on GDP forecasts. But the data shows there's surprisingly little connection between the two. The stock market often zigs when the economy zags. Trying to time it is, frankly, a fool's errand. So what's the result of believing all these myths? Well, according to an RBI report, a staggering 95% of the average Indian household's wealth is held in things like real estate and gold, assets that fail to generate returns above inflation. Just let that sink in for a second. 95%. We're all working so hard, but our money just isn't. Okay, so if that's the problem, what's the solution? Well, the book proposes this incredibly powerful framework. It's called the consistent compounding formula. Let's take a look at how it works. This right here is the big mind shift. Instead of obsessing over how much money you can make,
the focus completely flips. It turns to minimizing the chances of losing money in the first place. The whole philosophy is simple. If you crush the key risks, strong returns will just naturally follow. So how exactly do you crush risk? It comes down to focusing on these 3 pillars. First, find companies with clean, honest accounting. No funny business. Second, you have to identify companies with a deep competitive advantage, what some people call a moat that protects them from everyone else. And third, you look for management that is absolutely brilliant at using money to grow the business. Companies that tick all 3 boxes, those are your consistent compounders. This is exactly how you find those rare, Rahul Dravid-like companies. The book gives us a really simple ABC framework to categorize the entire stock market and help us pinpoint where the real, long-term value is hiding. This table just lays it all out beautifully. Type A stocks. Think of something like airlines. They really struggle to grow their earnings. Your returns basically depend entirely on luck. Then you have Type B stocks. These are good companies that grow with the economy. A good fund manager might get you a 19% return, but a bad one could leave you with just 5%. And then there's Type C, the consistent compounders. These companies grow their earnings at a massive 25% per year. And get this, even in a worst-case scenario where their valuation gets cut in half, they still deliver an 18% return. That's better than the absolute best case for a Type B stock. Now that is the power of a strong defense. But, and this is a big but, here's the catch. These elite Type C companies are incredibly rare. They make up less than 1% of the entire Indian stock market. They are, quite literally, diamonds in the dust. Finding them takes real discipline and a total refusal to chase those short-term fads. So, this brings us full circle, right back to where we started. To invest successfully, you don't need to think like a trader. You need to think like a champion. This quote from Dravid himself just perfectly sums up the entire philosophy. His goal wasn't to hit every ball for a boundary. It was to protect his wicket, to stay in the game, to simply not get out. And when you apply that same defensive, resilient mindset to your own portfolio, that's how you build wealth that truly lasts. So I'll leave you with this one question to think about. When you look at your own investments, what game are you playing? Are you going for the quick thrill, trying to hit a 6, or are you playing the long game, patiently building an innings to win the whole match? The choice, at the end of the day, is yours.